Major market resets rarely begin with panic. They begin with comfort. They begin when volatility is low, headlines are calm, and investors feel smart. Portfolios are near highs. Retirement accounts look healthy. The narrative is steady growth, soft landings, and controlled inflation. Risk feels distant. That is usually when the system is most fragile. A 30% market decline sounds dramatic when said quickly. But in historical terms, it is not rare. It is not extreme. It is part of the normal rhythm of credit cycles. In 2000, major indexes fell close to 50% from peak to trough. In 2008, the decline was even deeper. In 2020, markets dropped more than 30% in a matter of weeks before central banks intervened. These were not isolated accidents. They were stress releases in a leveraged system. So here is the simple question that frames this entire discussion. If markets fell 30% over the next 12 to 18 months, what would happen to a typical $100,000 portfolio? For many households, that $100,000 is not abstract capital. It represents years of savings. It may sit in an index fund, a retirement account, or a brokerage portfolio heavily weighted toward large U.S. stocks. On paper, it feels diversified. In reality, much of it may be concentrated in the same handful of mega-cap companies driving the index. A 30% decline would not just reduce that portfolio to $70,000. It would test confidence. It would change spending decisions. It would force choices about selling, holding, or adding more. And most important, it would expose how prepared or unprepared the structure really was. This is where the idea of a $100,000 escape plan comes in. Escape does not mean running from markets. It does not mean predicting an exact crash date. It does not mean hiding in fear. It means building a framework before stress appears. It means asking how capital behaves under pressure and positioning accordingly. The goal is not maximum return. The goal is reduced fragility. To understand why this matters now, we need to look at how past resets actually unfolded. In 2000, the problem was not simply that technology stocks were overvalued. It was that liquidity had fueled extreme speculation. When that liquidity slowed, prices had nothing to stand on. In 2008, the issue was not just bad mortgages. It was excessive leverage built on short-term funding. When trust disappeared, the system seized. In 2020, the economy did not gradually weaken. It stopped. Markets fell until central banks injected unprecedented liquidity. In each case, fundamentals were only part of the story. The deeper driver was the plumbing of the system, credit availability, funding markets, central bank response. Today, the surface looks stable. Employment remains relatively firm. Corporate earnings, while uneven, have not collapsed. Equity indexes sit near elevated levels. But underneath that stability, there are signals worth examining. Valuations are historically high relative to long-term averages. Index performance is heavily concentrated in a small group of companies. Government debt levels are far above prior decades. Interest rates are higher than they were for most of the past 15 years. That combination changes how shocks travel through the system. When debt loads are large, small shifts in rates have larger effects. When gains are concentrated, reversals can accelerate quickly. When passive investing dominates flows, selling can become mechanical rather than analytical. None of this guarantees a reset tomorrow, but it increases sensitivity. Complacency grows when recent experience feels normal. Over the last decade, many investors have learned one dominant lesson. By the dip, central banks will step in. Markets recover quickly. That pattern may continue, but patterns are not laws. They are conditions dependent on policy flexibility and confidence in currency stability. Preparing before stress appears is not pessimism. It is risk management. It is recognizing that cycles expand and contract. It is understanding that a 30% decline, while uncomfortable, fits within historical precedent. The real mistake is assuming that because markets feel stable today, the structure underneath cannot shift. So before discussing allocations, hedges, or liquidity buffers, we need to answer a deeper question. Are the old rules that supported the last decade still intact? Because if those rules are quietly changing, the next reset will not look exactly like the last one. And that is where we turn next, to the signals that suggest the framework itself may be evolving. If the framework is evolving, then the next question is simple. What exactly has changed? For years, investors operated under a set of assumptions that felt almost permanent. Stocks rise over time. Bonds provide safety when stocks fall. Central banks step in quickly when markets wobble. Diversification across asset classes smooths the ride. Those assumptions were not irrational. They were reinforced by decades of falling interest rates and expanding liquidity. But structural shifts are now testing those rules. The first broken rule involves bonds. Traditionally, government bonds acted as a hedge against equity declines. When growth slowed and stocks fell, central banks cut rates. Bond prices rose as yields dropped. The classic 60-40 portfolio to 60% equities, 40% bonds worked because stocks and bonds often moved in opposite directions during stress. But that relationship depends on a low inflation environment. When inflation is persistent, bonds can fall at the same time as stocks. Rising yields pressure equity valuations while also reducing bond prices. We saw this dynamic recently, when both sides of the 60-40 portfolio struggled simultaneously. This matters because many portfolios are still built on that older assumption. If bonds no longer cushion equity volatility during inflationary periods, the safety net is thinner than it appears. The second broken rule centers on central banks. For most of the past 15 years, monetary authorities had wide flexibility. Inflation was subdued. Debt servicing costs were manageable. When markets weakened, rate cuts and asset purchases could be deployed aggressively without destabilizing currencies. Today, that flexibility is constrained. Inflation, while off its peak, remains structurally influenced by supply shifts and fiscal expansion. Government debt levels are historically high. If central banks cut rates too quickly in response to market declines, currencies may weaken sharply. That can feed imported inflation and undermine confidence. In other words, policy support is no longer costless. Every move carries trade-offs. The perception that authorities can always backstop asset prices without consequence is being tested. The third shift is more subtle, but equally important: passive concentration. Index investing has grown dramatically over the past decade. Capital flows automatically into the largest companies because they carry the heaviest weights in major indexes. As those companies rise, their weights increase further, drawing in more passive capital. The result is a feedback loop. A small group of mega-cap firms can drive a disproportionate share of index performance. On the way up, this concentration feels efficient. On the way down, it amplifies declines. If those few leaders stumble, index-level selling can become mechanical. This does not mean passive investing is flawed. It means risk is more concentrated than many investors realize. When we step back, these three shifts connect. Bonds may not hedge effectively during inflationary stress. Central banks face tighter constraints. Equity exposure is clustered in fewer names. Each change reduces the system's margin for error. Now consider the broader context: liquidity and leverage. Liquidity refers to the ease with which capital moves through the financial system. It is influenced by central bank balance sheets, bank lending standards, and global dollar availability. Leverage refers to borrowed money used to amplify returns in hedge funds, private equity, real estate, and corporate balance sheets. The big signal emerges when liquidity tightens while leverage remains elevated. Historically, this combination precedes forced selling. When funding becomes more expensive or scarce, leveraged positions must be reduced. Assets are sold, not because they are fundamentally worthless, but because balance sheets demand it. This is how mechanical declines begin. Risk premiums reprice, valuations compress, correlations rise. A 30% drawdown does not require a depression. It requires a shift in how much investors are willing to pay for future earnings under tighter financial conditions. The process is less dramatic than headlines suggest. It is plumbing, not panic. So the conversation shifts from could it happen to what would trigger it: a modest slowdown, a credit event, a policy misstep. Any of these could start the repricing if the system is already sensitive. The system is not broken. Banks are better capitalized than in past crises. Corporate balance sheets, in aggregate, are not uniformly distressed, but the buffer is thinner. The tolerance for shocks is lower, and that leads to a deeper layer beneath markets and monetary policy, a layer rooted not in spreadsheets, but in physical constraints and global power. To understand the durability of this cycle, we need to look beyond financial assets and examine the real-world foundations they depend on. When physical constraints begin shaping financial outcomes, the conversation naturally turns to money itself. At its core, money is a claim on future production. A dollar, euro, or yen represents purchasing power, the ability to exchange currency for goods, services, and assets. When production expands faster than currency supply, purchasing power tends to hold. When currency supply expands faster than production, purchasing power erodes. This is where rising sovereign debt becomes central. Governments with large debt burdens face three broad paths. They can grow their way out by expanding the economy faster than the debt. They can impose austerity, reducing spending and increasing taxes. Or they can allow some degree of currency dilution, reducing the real value of outstanding obligations. Historically, outright default is rare in developed economies with monetary sovereignty. More often, the adjustment comes through inflation or financial repression, keeping interest rates below inflation so debt shrinks in real terms over time. Now consider how a 30% equity reset interacts with this framework. If markets fall sharply and economic confidence weakens, central banks face pressure to respond. If they ease aggressively, cutting rates or expanding balance sheets, liquidity improves and asset prices may stabilize. But expanding liquidity during periods of supply constraint can weaken currency purchasing power. The relief in nominal asset prices may come at the cost of higher prices in essentials. If, instead, central banks remain tight to defend currency stability and contain inflation, asset prices may reprice further. Higher real rates compress valuations. Credit becomes more expensive. Economic growth slows. Neither path is clean. Both create trade-offs. This is why the distinction between nominal and real returns matters. A portfolio valued at $100,000 may remain close to that figure over several years. On paper, it appears stable. But if the cost of housing, energy, healthcare, and food rises meaningfully during that period, the real purchasing power of that $100,000 declines. The risk is not just volatility, it is erosion. During periods of currency pressure, investors often shift focus. They look beyond nominal price appreciation and toward stores of value that historically hold purchasing power during fiscal stress. Gold has played that role for centuries. It is not tied to a single government's liability. Central banks hold it as a reserve asset. Silver, while more industrial, shares some monetary characteristics. Energy assets and certain real assets also function as partial hedges because their value is linked to physical scarcity. This does not mean these assets move in straight lines or always outperform. They can be volatile. But during cycles when confidence in fiat stability wavers, capital often rotates toward tangible stores of value. The mechanism is logical. If debt levels are high and growth is uneven, policymakers may tolerate moderate inflation rather than trigger deep contraction. Over time, that tilts incentives toward assets perceived as resilient to currency dilution. For the individual investor, this reframes the original $100,000 question. The threat is not simply that markets drop 30% and then recover. The deeper issue is whether the recovery restores purchasing power or merely inflates nominal prices while living costs rise faster. A reset, in this sense, is not only a market event, it is a monetary event. It forces a repricing of risk, of growth expectations, and of trust in policy frameworks. Understanding this monetary layer adds depth to the escape plan concept. It is not about predicting hyperinflation or collapse. It is about recognizing how debt dynamics, policy constraints, and real-world supply pressures interact. When viewed together, equity risk, bond instability, supply fragmentation, and currency dilution form a connected system. A shift in one node affects the others. And once we see that connection clearly, the discussion becomes practical. How does an individual navigate this environment without overreacting? How should someone think about liquidity, optionality, and risk when the rules are less stable than before? To answer that, we need to move from macro structures to personal decision-making, from global systems to individual balance sheets. If the financial system is more sensitive than it appears, the next step is to look beneath it. Markets sit on top of something deeper. They sit on energy flows, shipping routes, raw materials, and production capacity. Stock prices move quickly. Supply chains move slowly. When those two speeds fall out of alignment, stress builds. For most of the past 3 decades, globalization reduced costs. Production shifted to regions with cheaper labor. Energy flowed relatively freely across borders. Shipping lanes operated with limited disruption. Companies optimized for efficiency, not resilience. Inventory levels were kept lean. Just-in-time systems became standard. That model worked because the geopolitical backdrop was relatively stable. Today, that backdrop is shifting. Energy is no longer just an input cost. It is strategic leverage. Countries that control oil and natural gas exports influence global pricing and industrial competitiveness. When energy prices spike, transportation, manufacturing, and food production all feel the impact. Inflation is not simply a monetary phenomenon in those moments. It is physical. Metals tell a similar story. Copper is essential for electrification and grid expansion. Silver is critical in solar technology and electronics. Gold remains a monetary reserve asset for central banks. These materials are not abstract commodities traded on screens. They are foundations of industrial policy and financial stability. Semiconductors add another layer. Modern economies depend on advanced chips for everything from defense systems to consumer electronics. Production is highly concentrated geographically. When trade tensions rise or export controls expand, supply becomes uncertain. Costs increase. Investment decisions change. Shipping lanes and critical waterways also matter. When choke points face disruption, delivery times extend and insurance costs rise. Companies respond by building redundancy into their networks. That redundancy improves resilience but raises structural costs. This is where financial markets intersect with physical reality. Paper assets, stocks, bonds, derivatives can be created quickly. Credit can expand within months. Balance sheets can grow through accounting entries, but expanding energy production, building mines, or constructing fabrication plants takes years. Physical supply responds slowly. When demand for real goods accelerates faster than supply can adjust, prices rise. If governments attempt to offset those price increases through fiscal stimulus or monetary easing, currency supply expands. If they tighten policy instead, growth slows. Neither option is painless. Sanctions and trade realignment amplify this dynamic. When nations restrict exports of key materials or technologies, global supply fragments. Companies reshore or friendshore production to politically aligned regions. This reduces geopolitical risk but increases redundancy and cost. The result is a higher structural floor under inflation. Not runaway inflation necessarily, but stickier price pressure than many models assumed during the era of peak globalization. This shift reframes market risk. A 30% equity reset may not originate from corporate earnings collapsing overnight. It may begin with margin compression as input costs rise. It may stem from higher discount rates as investors demand compensation for geopolitical uncertainty. It may follow currency volatility as trade patterns change. The deeper battle is between financial engineering and physical scarcity. Financial engineering seeks efficiency. It relies on leverage, derivatives, and global capital mobility. Physical scarcity imposes limits. It reminds markets that growth depends on real resources extracted from the ground and transported across oceans. When the two are aligned, expansion feels smooth. When they diverge, volatility increases. Headlines often focus on quarterly earnings, central bank meetings, or political speeches. But the quieter story is about who controls energy flows, who secures access to critical minerals, and who dominates manufacturing capacity. That story unfolds over years, not days. yet it shapes market cycles in powerful ways. Understanding this layer changes how we interpret a potential reset. It becomes less about a single event and more about cumulative pressure from shifting global power balances. And when physical constraints begin influencing financial conditions, the next logical question emerges. How does this translate into money itself, into currencies, purchasing power, and the real value of savings? Once we move from currencies and central banks to personal balance sheets, the discussion becomes more concrete. A 30% market reset is not just a chart pattern, it is a lived experience. It affects retirement timelines, business decisions, home purchases, and confidence. The financial impact is measurable. The psychological impact is often underestimated. Start with sequence risk. Sequence risk refers to the order in which returns occur. If a portfolio falls sharply early in retirement or during a period when withdrawals are required, recovery becomes harder. A 30% decline followed by steady gains does not restore the same long-term outcome if capital was pulled out during the downturn. This is not about average returns. It is about timing and cash flow. Next is liquidity risk. Liquidity risk appears when assets cannot be converted to cash quickly without meaningful loss. In stable markets, liquidity feels abundant. In stress periods, it can disappear. Real estate transactions slow. Credit lines tighten. Even normally, liquid securities can gap down when selling accelerates. Investors often discover during downturns that they were fully invested but lightly prepared. Then there are behavioral mistakes. Sharp drawdowns test conviction. People sell at lows to stop the pain. Others double down without assessing risk capacity. Some freeze and avoid looking at accounts entirely. These reactions are human, but they can turn temporary volatility into permanent loss. This is why mental models matter. The first model is the liquidity pyramid. At the top of the pyramid sits cash and near-cash instruments. These are not exciting. They do not generate high returns, but they provide stability and flexibility. Below that are high-quality, liquid investments. Further down are more complex or less liquid assets. During stable periods, capital flows downward in search of higher returns. During stress, it flows upward, toward safety. Understanding where each asset sits in that pyramid clarifies how vulnerable a portfolio may be when conditions tighten. The second model is optionality over optimization. In late cycle environments, maximizing returns may increase fragility. Optionality means preserving the ability to act. It means holding enough liquidity to take advantage of opportunities during downturns. It means avoiding overextension through leverage or illiquid commitments. Optimization seeks efficiency. Optionality seeks resilience. The third model is asymmetry thinking. Asymmetry focuses on the balance between downside risk and upside potential. Losing 30% requires a gain of more than 40% to recover. Protecting capital during deep drawdowns creates long-term compounding advantages because recovery begins from a higher base. This does not mean avoiding risk entirely. It means structuring risk thoughtfully. Now we return to the concept of the $100,000 escape plan. It is not a single trade or prediction. It is a framework built on 3 pillars. First, a liquidity buffer. This provides psychological stability and reduces the need to sell productive assets during downturns. The size of that buffer depends on personal circumstances, but the principle is universal. Second, diversified exposure to productive assets, businesses, equities, and income-generating investments remain essential for long-term growth. The goal is not abandonment, but balanced exposure without excessive concentration. Third, measured allocation to monetary hedges or real assets that historically respond differently during currency stress. The purpose is not speculation. It is diversification across monetary regimes. Together, these pillars aim to reduce fragility. Preparation does not require predicting the exact month of a reset. Markets can remain elevated longer than expected, but building resilience early avoids rushed decisions later. This approach shifts the mindset from reaction to design. Instead of asking, when will the crash happen? The better question becomes, if volatility arrives, how will my structure respond? When individuals adopt this perspective, fear decreases, clarity increases, decisions become more deliberate. And with that clarity, we can step back one final time. We have examined structural shifts, supply chains, currency dynamics, and personal risk management. The remaining question is forward-looking. Given all of this, what are the most plausible paths from here, and how might each reshape the landscape in the years ahead? With the structural risks understood and a personal framework in place, the final step is not prediction, it is scenario analysis. No one knows the exact path ahead. Markets are complex systems shaped by policy, psychology, and global power shifts. But we can outline plausible outcomes and examine how each would affect capital, currency, and confidence. Scenario 1. Soft repricing. In this path, markets correct 20 to 30% over several quarters. Valuations compress as earnings expectations moderate and liquidity tightens modestly. Credit markets experience stress but remain functional. Central banks respond carefully, easing enough to stabilize sentiment without reigniting inflation. Growth slows but does not collapse. Unemployment rises slightly. Corporate balance sheets adjust. Excess speculation clears. Under this scenario, the system resets without systemic failure. Asset prices recover gradually from lower bases. The correction feels painful, but manageable in hindsight. Investors who maintained liquidity and avoided forced selling are positioned to deploy capital at more reasonable valuations. This is the most orderly path. It requires coordination, policy discipline, and a degree of luck. It assumes that debt loads, while heavy, remain serviceable and that supply chain pressures ease rather than intensify. Scenario 2. Inflationary reset. Here, markets decline initially, but policymakers respond aggressively to prevent deeper contraction. Liquidity expands quickly. Fiscal spending increases. Asset prices stabilize and eventually rise again in nominal terms. However, currency purchasing power weakens more noticeably. Inflation remains structurally elevated due to supply fragmentation, energy costs, and fiscal deficits. Real returns lag nominal gains. Equity indexes may make new highs, but the cost of housing, insurance, food, and services climbs faster. In this environment, savers feel uneasy despite rising account balances. Bonds struggle to deliver meaningful real yields. Capital rotates more heavily into tangible assets and regions perceived as fiscally disciplined. The reset, in this case, is less about collapse and more about quiet erosion. The system survives, but the value of money shifts. Scenario 3. Disorderly adjustment. This is the least predictable path. Liquidity tightens more than expected. A credit event, perhaps in commercial real estate, sovereign debt, or shadow banking triggers forced deleveraging. Markets fall beyond 30%. Policy responses are slower or constrained by inflation concerns. Confidence weakens not only in asset prices but in institutions. Currency volatility rises sharply. Capital controls or regulatory interventions increase. This scenario does not imply permanent breakdown, but it involves deeper and longer volatility. Recovery takes time. Political pressure intensifies. Structural reforms may follow. It is important to stress that extreme outcomes are not certainties. Financial systems adapt. Policymakers learn from prior crises. Private balance sheets in some sectors are stronger than in past cycles, but the margin for error is narrower than during the low-rate era. High debt, geopolitical tension, and concentrated market structure reduced flexibility. The purpose of outlining these scenarios is not to assign probabilities with false precision. It is to recognize that different paths produce different winners and losers. A portfolio optimized for one environment may struggle in another. The $100,000 escape plan is therefore not a bet on collapse. It is a design built to remain functional across multiple outcomes. If a soft repricing unfolds, resilience allows participation in recovery. If an inflationary reset takes hold, diversified exposure to real assets cushions purchasing power risk. If disorderly adjustment emerges, liquidity and asymmetry reduce permanent damage. The future will not match any scenario perfectly. It will likely blend elements of all three. That uncertainty is not a flaw in the analysis. It is the core condition we must operate within. And that leads to a final consideration. If cycles are shortening, if geopolitical fragmentation continues, and if monetary regimes are evolving, then this potential reset may not be the final chapter. It may be part of a broader transition into a different economic era. In the next discussion, we will explore what that era could look like, and how shifts in global monetary architecture might redefine the rules investors have relied on for decades.